Well, good evening. My name's Adam Tooze. It's my great pleasure to welcome you here to this event on behalf of the European Institute. We're delighted to have with us this evening Marco Buti of the European Commission of ECOFIN, Director General there. Marco was visiting us, we were saying, before the what was the word we came up with? The apocalypse, the
Armageddon.
the Armageddon, the deluge. Sometime in the spring of 2016 was our last conversation about Europe, and it was an extraordinarily interesting conversation then, and I expect it will be this evening as well, because Marco's really as well placed as anyone could be to give us Europe's view, the European Commission's view of the state of play in the European economy. He has a 30-year career in the European Commission, and the extraordinary sort of historical distinction as having taken over as Director General at ECOFIN in 2008, just as the crisis reached its first and most intense phase. So please join me in welcoming Marco, and let's all look forward to a great discussion. So you're going to give us a pitch on your view of the situation at this point, and then we'll enter into Q&A from there.
Okay, great. Thank you very much. Maybe I stand up so I can see the slides myself. Okay, thank you very much, Adam, for hosting this. And it's the second time, so hopefully we do it. We establish a little tradition. Whatever will happen to me in my future life. Yes, indeed. You mentioned that. I took over the Director General for Economic Financial Affairs just at the moment of the crisis around Lehman. If you think I bring bad luck, you can touch. So basically, yes, indeed, I have gone through the crisis. It has been, has been an extraordinary, also personal experience with. The climax in 2011, 2012, before the famous whatever it takes of Mario Draghi, when before the screen, you looked at the. I remember at a certain point it was the Financial Times who was doing the live coverage of the Euro crisis, as you do it with for a hold up in a bank, or as if the euro was about to collapse any moment. And I think this is this anecdotal only, but I think one element that definitely was underestimated at the time is that at the end of the day, the degree of ownership and capacity to spend political capital on safeguarding the euro has been very high, with all the vagaries of the crisis, and we are going to discuss some of this now. Okay, this is the plan. Reading of the crisis, so first block on different interpretation that are there in the debate, in the economic literature, and the media more generally. And snapshot on the crisis response, and then try to look forward what we need to do in the, let's say, present circumstances, with also the the political landscape that is moving in Europe. It's moving around the world, but in Europe also. So on the reading of the crisis, let's remember where we come from. Here, this is just a snapshot on a few elements. What happened? Usually, the crisis, is associated with Lehman 2008, but in fact, it started beforehand, and is exactly 10 years, or 10 years ago, just a little bit longer. And it started with financial crisis, subprime, actually on this side of the Atlantic. And then the crisis morphed into, from a financial to a banking to an economic crisis. I think the financial, banking, and economic is common across the Atlantic. Then it installed itself in Europe, and there I think there has been the institutional and the sovereign bank nexus, which actually has characterized Europe and the euro area in particular. So the first three elements, so the loop, financial, banking, economic slash social, common, I think, in the industrialized world. I think the specific element of institutional in the sovereign bank negative loop, which instead has been typical of Europe, I think is one of the features which has made much more complex the overcoming of the crisis in Europe. And here you have some of the key moments. Now, I think there are two questions basically at the very high level of generality. I mean, the first one is what is the origin of the crisis? And the second, I have already given a little bit of an answer to the second question, is why did Europe overcome it much more slowly than the rest of the world? I mean, there are two different questions. So where it comes from and how come it found its place in Europe and they made so much more damage there. Now, on the first question, I think there are different readings out there. I mean, the first one is the typical, let's label it in inverted commas, the German reading. So it is the fiscal profligacy in the south, basically misbehavior on the fiscal side, public finances going out of control, debt too high in the let's say in the good years before the crisis, and then there was the crisis was ignited, and that was let's say the basic reason was this misbehavior, essentially on the southern rim of Europe. Second one is financial regulation flaws. A third one is misallocation of factors of production actually in the good years before the crisis. And keep this in mind because I think there is quite a bit of truth in the third one. Now, my reading of this is that basically the crisis was a sudden stop following capital misallocation in the pre-crisis years. I'm going to try to show that in further slides. The banking crisis triggered a feedback loop. So there was, I mentioned it before, bank solvency concerns, higher bond yields and debt service, default worries, deeper recession. Also, there was a loop there that was important. It's much more important in Europe than in the US for essentially because I mean Europe is much more of a bank-based economy than the US. They are trying now to actually complete an capital markets union. So banks much more important than in the US, and with a lot of holding quite a lot of public debt, which is clearly when the tension came, there was a negative loop there. In certain countries, actually originated in the banks, and here the typical cases are, let's say, Spain and Ireland, where the banks who infected the sovereign, essentially through the collapse in the housing market, which made non-performing loans go sky high, and then problems with to the sovereign. In other cases, it was the other way around. And the other way around was it was the case of Greece, I think Portugal to a certain extent, Italy, even though Italy is not part of, let's say, has not hit as frontally as the other countries. My assessment is that the euro area crisis was not a fiscal crisis, apart from Greece, but and we'll come back to that in a moment. Lack of fiscal space, so the very high debt the countries entered into the crisis with actually limited the room for maneuver in using fiscal policy for reflationary purposes. Greece is, it has been the tail wagging the dog, because the fact that it came first, it tainted, I mean, the reading of the crisis. In a sense, had here been Ireland first hit, where Ireland entered the crisis actually with very, very low debt levels, and the debt exploded because of the banking crisis, probably we would be here now telling a different story. But Greece came first, and to a certain extent, affected very much the reading of the crisis. Whilst there was in the pre-crisis period nominal and to a certain extent also real convergence. Nominal convergence, you take nominal variables, interest rates or inflation, and to a certain extent also real convergence in terms of GDP per capita, actually underlined that there was quite a lot of divergences and heterogeneity in the growth models. And what is very important, because I don't think you can understand the crisis by simply, as economists like me do, simply looking at macroeconomic variables. I think here the loop is not only within the macro with the banking, there is also the political, and the political economy is absolutely fundamental. So what happened here, I think, is this bullet here is key in the interpretation, is that in the pre-crisis periods, actually underneath the surface there has been divergence, not convergence. So, and I'll document that in a moment. And the fact that this divergence actually lasted for basically 10 years and came on top of different also historical and institutional features of countries. Actually, this structural divergence in the economy affected also the social and political preferences of countries. So we have had, so when countries in Europe had to face the crisis, they provided the policy response, then the social and political preferences came up in a very prominent way, and then what happened that it was very difficult to find an agreement on the way forward. So we actually operated under, let's call it here, the ultima ratio mode. What does ultima ratio means is that you act only when your shoulder is against the wall. So it is only when you are facing the abyss that you find the courage somehow to bounce back. And it means also that when the situation improves, immediately the complacency tends to set in, and instead of seizing the good moment, actually policymakers fail to act and ride the good momentum. So when we come to the final part of the presentation, we'll have to discuss how to avoid this in the present juncture, which I think is an important element. So you can see that there is an element here of let's say interplay between the economy and politics, and all this has to be taken into account in reading the crisis in Europe. Now here is some of the structural divergences which I emphasized before. What you have here is that here is the euro area center, and here is the euro area periphery. When you come to this to do this kind of grouping of countries, there is always a fundamental choice: is that where do you put France? I think here it is in the center, but if you take a different, examine a different issue, maybe you want to put it in the periphery. But okay, here is in the center. But I declare it before you ask yourself. So, and what you have here, this is the cumulative growth rate of non-tradables over tradables in terms of added value. So, when you are so down here, or when you're up here, so here it means that the countries of in the center of Europe, so the core, so Germany, the Netherlands, and here also France, actually had tradables growing more than non-tradables. So non-tradables here, so services, housing, so what is clearly not non-tradable, and the opposite when you go up. And you look at Euro area periphery, you see that the growth rate on non-tradables over tradables increases a lot. And you have years in the pre-crisis period, especially 2006, 2007, so just before the crisis, where you have the extraordinary explosion of the housing, housing markets there, and non-tradable services. So, and you can see the Euro area periphery a lot becoming much more intensive in non-tradables, so in services, and the Euro area center actually becoming more intensive in tradables. So more competitiveness, and here Germany, the Netherlands, clearly at the core of that. And this is the pre-crisis period. So 1999, 2007, where you can see that before launching EMU, there's no big difference between the two.
Mm-hmm.
You launch EMU, and what happens there? I mean, this is not, in a sense, it's not surprise. Why? Because you have the dramatic convergence of interest rates in peripheral countries. Peripheral countries had a high inflation rate. They had before joining EMU, they had high interest rates. So you had collapse in spreads, lower interest rates, but also not only that, but also access to credit more generally, not only in terms of price, but also in terms of quantity. So a lot of credit, and we know what happened. This is the basis for the misallocation of capital, because not only you had capital going to bubble-prone sectors, but it's also sectors as we say, I mean, at low total factor productivity. So you cannot really count on those to create growth on a permanent basis. So this happened in the periphery. This is the structural divergence I talked about. And when you think about Germany, which is quite a lot responsible for this here. I mean, the whole story about competitiveness, etc. I mean, which actually is reflected into the the popular preferences and the political preference. This is comes out accentuated in the first 10 years of EMU. So in a sense, the fact that we had troubles during the crisis, yes, the shock was massive, and we have seen in this country also, but it was superimposed onto something which went wrong before the crisis. This, I think, is key in understanding a bit the dynamics. What happened there is that with the bubble bursting and the collapse in growth, there was financial dry out, and also banks getting into trouble. So central bank lending actually replaced lending by credit by the market. So you can see that for countries in trouble, you see here the central bank lending to credit institutions. There is collapse of trust. They don't lend to each other. Interbank market actually freezing, and then it's the central bank actually that comes in and does the job. Now this is if you go back to end of 2008 till basically today. You can see the story of the crisis through the spread to the bond. So the German 10-year sovereign bond, and here there are certain key moment in the crisis. So this is the first Greek program. I have to say that Greece here is, I mean, in terms of spread, is so large that it trumps a little bit the others. It squashes a bit down the others. I mean, this is very high spreads also. So the blue one, anything. So one could have done it with a different scale, but you know that is okay. You keep it in mind in looking at the. Here, Deauville is a key moment in the crisis, and you can actually fast forward to the discussion today. Because some of the ideas that are coming out in the debate have to be placed, having in mind what happened in Deauville. So Deauville is a beach in France, beautiful touristic resort, where there was a meeting between the French President Sarkozy at the time and the Chancellor Angela Merkel, and at the moment they decided that PSI would be acceptable. PSI is a very nice acronym for private sector involvement. Private sector involvement means that basically the debt you are holding, the sovereign debt you are holding, can be restructured. So it means that you do not get back what you are expecting, what you have invested into, but there would be, the possibility of a haircut. This was a turning point in the crisis, because immediately markets and portfolio holders and etc. thought that okay, what we are holding in terms of sovereign debt is not as we thought safe and can be reimbursed as by the sovereign, but it can be actually restructured. So this was the agreement in Deauville. This took place actually. This bilateral meeting took place while we were in Luxembourg for an ECOFIN council. ECOFIN, so the finance ministers, and the news came as a thunder there. It caught by surprise. So the finance ministers, they are including those, at least one of those of the two countries involved there, and we saw the danger immediately because of the market psychology of this. And what you can see immediately here, so spreads go up, and that is when I told you the little story of the financial, the hold up coverage in the Financial Times actually took place after this period here. So that is. So we went through Greek program, Irish program, the Spanish program also, even though the Spanish is not full IMF EU program, is more focused on financial, and it took the whatever it takes of Mario Draghi in July 2012 to actually make the crisis, subside very much. You know what happened in the July 2012? You all know? Then otherwise I tell you. So,
spell it out. It's better to spell it out.
No, I tell you. So Mario Draghi was doing what I'm doing now here, much more modestly, at the London School of Economics. So at the London School, he was giving a speech. He had not told the member of the governing council of the ECB, and what he said in the middle of the speech, he was talking about the financial crisis. He said that the ECB is ready to do whatever it takes, to save the euro. Then he paused, looked at the audience, and said, "And believe me, it will be enough." This changed the crisis, the course of the crisis. It was clear that the perception of markets was that the ECB somehow, implicitly or explicitly, had been given the mandate by the core stakeholders of the euro area to actually do its job and save the euro area. So it was not only, it was certainly the unlimited firepower of the ECB, but the perception was also that Mario Draghi probably could not have done it just by himself. I don't know what the real story is behind this, whether there was, but certainly this had an extremely, a huge impact on the markets, and basically that was the beginning of the end of the crisis, at least the one where at least the end of the existential part of the crisis, because before that the risk of dissolution of the eurozone was actually present. Here there was clearly there has not been peaceful. Then ECB announced quantitative easing during 2015, and then we know what happened later on. Now, I mentioned before that the crisis, in my view, was not a fiscal one in origin, apart from Greece, but public finance actually affected the crisis in terms of the room for maneuver that countries had or didn't have to respond to the crisis. And here, what you can see is actually this is the pooling of previous crises of the past 40 years. So sizable crisis, not cyclical, upturns or downturns for different groups of countries, and the reaction. So this is the crisis in starting period T, where we come from and where we go. And this is actually the latest one. So what is key here is the intercept here on the y-axis. So basically, countries in Europe entered the crisis with a much higher level of public debt. So it was this limited, the room for maneuver for fiscal policy to play the stabilizing role. This lack of room for maneuver actually was added to also a view that was more skeptical in Europe than on this side of the Atlantic on the role of fiscal policy in countering the crisis. Now, come to the second question. So this was the origin of the crisis. So the second question is why the crisis lasted longer in the euro area. And here again, you have different views. This is the first view is that the austerity is actually is what made the crisis last longer. So this is in a sense is the opposite of those who see the fiscal profligacy as the origin of the roots of the crisis. Second, that structural factors. So in the US, you had bouncing back reallocation of factors of production and more flexible markets that helped to respond more quickly. Third explanation is that the bank weaknesses and the bank sovereign nexus. Here, a key difference between the US and Europe is the speed at which banks have been let's say restructured and rationalized, and then finally institutional incompleteness. So the fact that the crisis hit Europe whilst the institutional system was still not not fully established. I think all these elements played a role in that. I think of all this, what I think is that at the roots of the existential element of the crisis, I think is probably this one, the institutional incompleteness. I think a key element where there is a clear difference between the US and Europe is on tackling banks, the banking problems. Now, I said the crisis caught the euro area in the middle of the river. You have seen that we entered the crisis with a high level of public debt. So in the insufficient capability of enforcing discipline in good times. Fiscal in good times, I think, played a role in limiting the possibility to use fiscal policy. Here again, I mean, the kind of apparatus of fiscal rules that we have is essentially an asymmetric one. So we tend to limit excessive deficit, but very difficult to constrain countries to, let's say, to spend more if they don't want to, and very difficult in good times when the automatic stabilizers automatically help the public finances to, let's say, to say, well, be careful here because you may actually lack the room for maneuver when the downturn comes. There was also weak non-fiscal surveillance. When I showed you the divergences in structural terms, I think that mirrored also a huge intra-euro area imbalances. So with some very large and persistent external surpluses mirrored by in other countries, in the peripheral countries, by large external deficit in running the crisis. So the fact that we had the focus was essentially on fiscal surveillance that did not look at the macroeconomic surveillance more generally, I think is an important element. We also lacked financial backstops. I mean, what we have now, I think, is the 5th anniversary these days of the creation of the European Stability Mechanism that was created about 5 years ago. We did not have a crisis response mechanism in order to help countries hit by the crisis. I mentioned before the perverse links between banks and sovereigns, and on the financial market side and the financial regulatory agenda, actually, we had very segmented responsibilities, and we did not have a banking union. Actually, banking union was put forward only in the summer 2012, and we are still working actually on that at this very moment. Now, in terms of crisis response, I think it has been a comprehensive crisis response by European standards, actually pretty quick, considering the difficulties and the fact that we have quite laborious decision making. So with monetary, fiscal, and structural policies, we have created financial backstops, the EFSF. So this is the European Financial Stability Fund. I think I have to say
facility.
Facility. EFSM, which is mechanism. EDM is mechanism. This was 550. This was only 60. Then this here migrated into the permanent system, which is a stability mechanism. Actually, when I give these presentations here, not precisely this is prepared for this specific occasion, but I do that in China. Chinese students are brilliant for acronyms. They bail me out always because I mean you can. This is only a couple, but you have plenty of acronyms, and they know them all. So that is okay. This is maybe as an indication of a certain type of teaching. Okay, so we broadened surveillance with the macroeconomic imbalances procedure, strengthened the fiscal rules, launched banking union, and started to work on capital market union. So massive changes in the interinstitutional side. So monetary policy response. Okay, here we can go very quickly on this. You had the interest rates, say before the crisis, and then the response of the ECB, which was actually pretty sharp here, mirroring what the Fed also did. ECB had a bit of a problems here in 2011 when actually thought that the crisis was basically over. There was an increase in inflation, but it proved very transient. So here it is seen as this increase in interest rates during the course of 2011 was actually seen not a brilliant idea, and then there has been a move towards a further reduction in interest rates, actually going into unimaginable territory, because we go with actually negative interest rates. So when we have studied economics, we thought that there was a zero lower bound for nominal interest rate at zero. Human ingenuity and central bank ingenuity actually bypassed that, and now it is still with negative interest rates. So this is the part on the conventional response, so on markets, and then you had the pretty extensive response in terms of the quantitative measures and intervention in the markets, which has been reflected in the very strong increase, especially as of 2015, of the balance sheet of the ECB. So the balance sheet of the ECB basically went from around 1,000 billion euro before the crisis, so in 27, to over 4,000 right now, and it is actually more or less what the Fed also did. The Fed went from, in terms of $1 billion, from just below 1,000 to 4,500. So I think the central banks actually responded quite massively. We had the pro-cyclical swing of the fiscal pendulum. I think whilst in this country here the fiscal policy and monetary policy marched together, in Europe we had the actual fiscal policy which helped at the beginning of the crisis, is helping now, but we have had a problem basically in the 2012 and 2013. That's the austerity period. This was actually the moment in which a number of countries lost or risked to lose market access. So in a sense, they were forced to carry out pro-cyclical fiscal policies, which clearly did not help in terms of sustaining the economy at the time. We had quite important structural reforms, but mainly in crisis-hit countries. Here you have OECD indicators, so labor market reforms and product market reforms. And you can see those who actually did most at Greece, Portugal, on both counts, where I think they were the countries more under pressure. So the ultima ratio modus that I mentioned before is not only in terms of the response at the European level, but is also in terms of the policy response at the national level. So structural reforms actually were made only under duress here. Other countries, those had been gone through the crisis with a somewhat more peaceful, situation. I think they did less reforms. These are the institutional changes which took place. This is the period of the crisis. This is a bit the post-crisis period. So these were the ESM, the two-part fiscal compact, and then in the building of the new infrastructure. Here is the European Fiscal Board. There is a fiscal council that we have at the European level, the single resolution mechanism, and so on and so on. So you can see quite a lot of, we don't go into this all, but you see quite a lot of activity in terms of institutional building since 2011. So overall, a difficult crisis aftermath. I think if you fast forward to now, quite a brighter outlook. We had slow recovery and lower growth, but now the situation has improved quite substantially. We had now 17 consecutive quarters of growth in the euro area. Last 2 years, growth actually higher than in the US. Stubbornly low inflation. I think this is one of the the elements which motivates the continuing expansionary stance of monetary policy, and weak total factor productivity, so basically reflecting potential growth pretty low looking forward. So I think it is particularly important to invest in boosting the productive potential of the economy. Banks weak during the crisis, but capital has been rebuilt, and the non-performing loans still a high level, but started to come down, and actually quite rapidly. And we have a high debt, public debt legacy. So basically, public debt and also private debt. As I said, public debt not as the key factor at the beginning of the crisis, but certainly an element which we have to reckon with now, even though it is more the effect, than the cause of the crisis. Now, we are doing better, but the recovery is still incomplete. Here, we have a graph which tries to picture a bit the in various dimensions why the recovery is not complete in Europe. Here, this is the investment gap, so the investment to GDP ratio now compared to the long-term investment ratio, because they're still not there. There is a labor market slack, in spite of the fact that labor markets has behaved actually pretty well. Employment has gone up. There is still a slack there if you consider estimate of structural unemployment or other measures unemployment like part-time or precarious work. Persistently low inflation, as I mentioned, and also a high external surplus, which is historically high level, which is an element I'm sure that will be discussed in the next couple of days in Washington at the annual meetings of the IMF, amongst the many interesting things that we discuss there. Financial and fiscal fragilities, fiscal deficit, public debt, non-performing loans. The situation is getting better, but there is still work to do to reduce fiscal fragility. Now, looking forward, now the journey is not over. I think we are in the building, still in the building phase. The EMU architecture is not complete, so we have to continue to work on banking union, on fiscal union, on economic union, whatever these terms actually mean. We can discuss later if you like. I think it is clear that what the latest political developments have brought to the fore is that we need to reorientate what we spend at the European level through the EU budget through new European public goods. So basically here, all that is for defense, security, for the migration policy, I think this has, compared to the common agricultural policy, which is a little bit more passé. And I think what we need to rebuild in all this is trust, because this is key in order to go forward together. And trust has been undermined quite a bit during the crisis, and that is an element on that. Now, on completing EMU, I think we have to bridge different positions. Here, I put in red certain features, and I put in blue other ones. Now, let's test for you. So, who is behind? Tell me a country that is behind the red one.
Germany.
So, okay, and I give you another chance. Okay, read again.
Focus on rules as a key indicator here.
I'm talking about the left-hand side here, on the red. Okay. So, okay, Spain sits here, yes,
Greece.
broadly. Is it Greece even more to the left? Okay, and then Italy, yes?
Greece.
France.
France,
France.
naturally, you know. Okay, so but this is the, and okay, tell me who sits on the
Germany.
okay, German. That's good, very good, excellent. And here also.
Yes.
Okay, so basically, for to complete EMU, we have to bridge this divide. Here, there are those who tend to emphasize more, let's say here, the risk-sharing element. So more solidarity, and but also they have a view of the economy. Have to put more emphasis short-term response, I think, on demand, etc. Others, they emphasize more the risk reduction. So discipline, you know, long-term structural reforms rather than macroeconomic policies, more rules instead of discretion, you know, supply side rather than the demand side. And this is on the economic side. Then you have on the institutional side also that is there is this divide. So Germany is it's more for political union, but then you have to have treaty changes, and you know more in actually in the current phase on the intergovernmental rather than the community. So and the others they stand on this side here. So bridging this divide here, both on the economic on the institutional side, I think is key in order to move forward to complete EMU. So how to bridge this divide? I think on financial union, economic union, and fiscal union, you have to, I'd say, under each dimension, you have to have the risk. You know, so on financial union, so banking union, risk sharing and risk reduction. What does risk sharing mean? It means that we need to move towards a common deposit guarantee. The Commission will come forward tomorrow with some proposals in order to make it more, you know, realistic. It has to go down hand in hand with risk reduction. So, reduction in the riskiness of the banks, so that you do not, you know, profit from the strong deposit guarantee of Germany if you have, you know, a weak bank in Portugal. So we have to reduce the risks there, in particular on non-performing loans. I think on the economic union there is an issue of structural reforms, also, but also the incentives, possibly the use of the EU budget in order to provide incentive for reforms for economic union. And on the fiscal union, yes, you need to have a sound budget, but also the possibility to have fiscal capacity at the center to intervene and supplement the national fiscal stabilizers. So, new European public goods, I mentioned it before, defense, security, migration, but also fight to climate change, R&D, cross-border infrastructure. These are the, let's say, a reorientation of the EU budget. The currently is a bit of, put it here, relic of the past. You know, looking in the rear mirror rather than looking forward. And also the possibility to strengthen macroeconomic stability by providing incentive for structural reforms, and also supporting a stabilization at the center. Now, this is my final slide. I leave it for you before discussion with Adam. So I think we have a window of opportunity. This is what Commissioner Moscovici, he came here a few weeks ago, and that's what he said. Now, will politics follow? Now, Adam said that I came here giving talk of the same format in spring 2016. That was before Brexit vote. It was before Trump. It was before Macron. And it was before the new Merkel. So a lot has happened since then. I think in Europe, at least in Brussels, and we live in Brussels a bit under a bubble. We go from euphoria to depression and vice versa. So we were, you know, before, you know, depression before the election of President Macron. Then huge euphoria because Macron, you know, very strong, very determined, powerful, optimistic, looking forward. I mean, the threat of populism having been defeated, and it did not go that far. It was not close, but it was not evident either that Emmanuel Macron would win the presidential elections in France. Now Germany, there has been a relapse again of a bit of less optimism now that we have seen the AfD, 13% of the vote, in a composition of the coalition that one may see as not particularly pro-Europe. Maybe you can leave it for the discussion whether that is, how we make up the politics out of this. Thank you.
Thank you. Well, you can see, I think, why we're always so keen to host Marco when he comes through for IMF meetings, and because it's, I think, coming from don't take this the wrong way, but a civil servant. It's a remarkably frank, remarkably full, a remarkably rich kind of accounting that you get from him, from the inside. Not surprising when you understand that he sort of moonlights as an academic economist on the side with publications, including perhaps the sort of definitive official view of the euro just before the crisis hit. And then listening to him, and I had the same experience last time, I'm always left a little kind of dizzy, because listening to you, there's a sort of strain of very quiet heresy that runs through so much of what you've said. I just kind of want to recap the stages of this today. So you focused on the failure of convergence during the boom phase of the euro up to 2008. Now, the significance of that is that for the EU, convergence is the totem, right? And it's measured in terms of GDP per capita, and it appeared to be happening. So for the senior economist of the European Commission to be saying, whoops, well, in retrospect, though at the macroeconomic level it was happening, we should have been looking inside the Spanish economy, and what we would have seen there is an unproductive boom in the housing sector. That's a huge statement. It's then followed by this, and you did this last time as well. You set out the different interpretations of the euro crisis. Was the fiscal interpretation at the top, and we know it's the German interpretation. And then in the next slide you say, that's not actually how I think it happened. And in fact, it's sort of an unfortunate coincidence that the Greece crisis exploded first, because really, the real essence of the Eurozone crisis is to be seen in Ireland. And then it's actually much, much more like something that's happening in the United States, where a banking crisis and a real estate crisis turns into a public debt problem. But then you don't stop there. So this time, you also told us that the two leading politicians of the Eurozone, Merkel and Sarkozy, off their own bat, without coordinating even with their own governments, go to Deauville and launch a bomb into the public debt markets, which causes the spreads to explode. Now, this again is generally sort of a heretical view from the outside, and it's deeply politically troubling. And then this time, to add even more, we get to 2011, and looking at the graph of interest rates, as you said, there's this rather odd decision by the ECB to raise interest rates not once but twice during 2011, which is widely regarded as a sort of failure of ECB interest rate policy of historic proportions. It's up there with the Federal Reserve in 1929, 1930 as a misinterpretation. Then the saving moment comes in 2012, and again, you confirm our sense it came kind of out of nowhere. Like Draghi hadn't liaised. Draghi just decided that something had to be done. And it was kind of this miraculous moment where the Eurozone is saved by a kind of piece of magic, in a sense. Or we know there's more actually going on in the background, but the extraordinary thing about this is how freely it floats, right? How little security it seems to be based on. And then, as it were, to kind of conclude this essentially kind of heretical narrative, you tell us that the pro-cyclical, or sort of the pro-cyclical Essentially, it is a pro-cyclical tightening of fiscal policy, or the Eurozone tightens fiscal policy into the slump in 2012, 2013, which is obviously disastrous for several of the economies. The one slide that we don't have that would have really driven this home is peripheral unemployment amongst young people, that would have really completed the normal heretical account, which is that this constitutes, taken together, one of the most disastrous phases of economic policy in the modern period, which I think is the kind of common assumption on the part of most economic commentators in the Anglosphere, that something terribly bad went wrong here. And every single stage of that narrative you essentially present to us. And so my question really is, out of that, how do we rescue a positive story about the EU other than that it survived, right? The Eurozone didn't implode. It held together, and now we can move on and we can look to the horizon, and then we move on to a kind of a narrative of reconstruction. But there's a sort of a boldness and a frankness that I just find difficult to compute in political terms. If the Commission knows this, how do you deal with the Germans? Like, how do you sit down? How have you been able to sit down with Schäuble all these years, given that he doesn't agree? I mean, I don't think he agrees. Anyway, this for me is the puzzle, because I admire the frankness, I appreciate it, I agree with most of it. And then nevertheless, the conclusion as a European citizen, well, still for a couple of months a European citizen, I'm left wondering how, for all of these reasons, the EU is in political trouble, surely. Isn't this the reason why the EU has the legitimacy issues that it develops? Precisely the narrative that you sketch out for us so clearly and so honestly.
Okay. If I have been too heretic, maybe as Grispan said, maybe you have misunderstood myself. No, I think one has to be honest and look back at what we did wrong and what we did, I think, fine, and what was inevitable at the time. I think what we were hit by a shock of historical proportions when in a moment in which the institutional architecture was actually not there.
This is being caught in midstream.
In the midstream. Yeah. Actually, it's a pity. I don't have it here with me, but I'm giving a speech tomorrow at another conference and look a bit at the parallel between European integration and the US.
The historic emergence.
The historical, and here sometimes maybe not in this country, certainly not amongst reputable historians, but in the Vulgata there is the impression here that the US federal system came out of a Hamiltonian moment all of a sudden. Not true. Not true. It took 240 years to be achieved.
No Fed till 1913.
Precisely. I mean, you look at this is on the monetary side. You do not have a sizable central budget for the US until the 1920s. Yeah. So it was only then afterwards it was the crisis, the New Deal, etc., and then ratcheted up. So I mean, what we do in Europe, to a certain extent, is on a step-by-step, but in a highly accelerated fashion, so which poses enormous problems clearly, and we were hit frontally by the crisis in the period of construction. So the fact that we did not have been in the middle of the river while crossing, we did not have banking union, made very, very difficult to solve the banking problems and actually strengthen the nexus at the sovereign, the national sovereign and national banks.
Yes.
So this is it is true that we had the austerity period, which one has to acknowledge, was, clearly dampened demand
Yes.
at that moment. One has to consider, however, at the same time, as I mentioned before, maybe a little bit en passant, that you had the countries which were on the verge of losing market access,
Yeah.
which had not other choice but actually being very prudent and very restrictive. Looking at in 2011 here, in one of the graphs on the, it is not highlighted there, but in the graphs on the spread, maybe I recover it here. Which is maybe useful to
That one
here.
there.
Yeah. No, basically what we have here, end of 2011, in Italy, the crisis of Berlusconi's government.
Yeah.
So which also here, as I said, all the spreads here, they are squashed by Greece, But here there was a very strong
And
surge.
these are spreads, right? So the actual borrowing cost for somewhere like
Well,
Spain
it's,
goes
you
to
know,
7% in the summer
So
of
that's
2012.
high.
And at
So-
7%,
Yeah.
they are fiscally unsustainable given the amount of debt they have
Yeah.
to roll over.
Precise. So that is so what we had here is a period in which countries under stress actually found no other way than actually run a restrictive fiscal policy. Then the question is, okay, countries with fiscal space could they have stepped in and run an expansionary fiscal policy? The answer is maybe yes, maybe not. First of all, okay, you had on the German side the traditional skepticism on using fiscal policy, even though they did in 2009 at the beginning with a strong impulse, but they were not willing to do that any longer in 2011, because there what we had is that we had a conflict between, let's say, national objectives and European objectives. Basically, Germany did not really need it for itself. They would have done it. They should possibly they should have done it, but maybe for the sake of the others. But this is not particularly, in terms of political incentives, is not particularly thriving. So, what one of the proposals that we have actually, as in the fiscal union, is to establish a central fiscal capacity, which would actually step in order to boost demand and sustain the cycle from the center, and not only relying on the aggregate fiscal stance coming out of the addition of national fiscal stances. So, true, there were elements of mistakes, I think, at the time. Possibly again, I think coming from before the crisis more than.
Do you think they were mistakes? Because the more cynical interpretation, I think it's not even just cynical, I think it's realistic, is that the ECB was playing a game of chicken with governments it didn't think were reliable in terms of fiscal discipline. And that game of chicken got very, very dangerous indeed on several occasions in 2011 and 2012. And the Germans are aiding and abetting a game being played by Trichet and then also by Draghi, which is how far can we go in ensuring that bond markets exert massive pressure on these states, which then, as you say, have no option but to engage in very dramatic austerity programs. So it seems to me that one way of reading this is as a sort of a macroeconomic policy mistake. Another one is that what Europe is witnessing is a sort of long-run program of fiscal discipline and fiscal consolidation that in Germany goes back to the discussions which lead up to the debt brake constitutional amendment in 2009, but start already in 2005. And in a sense, what they're trying to do is to ensure that everyone in Europe moves to that higher level of discipline. And what we perceive of as being bond market crises are, in a sense, a strategy of tension. They're a kind of tactic to ensure that governments they think are going to be backsliding actually do the fiscal work, do the adjustment work. That then has very negative macroeconomic consequences, but those have to be kind of accepted as part of the bargain, because you've got to get to this discipline structure apart from anything else, so as to enable Europe to then move to the next level of integration, because without discipline the German electorate won't accept it.
I think you're going too far. I think there is certainly some elements of okay, let's recall it. The fiscal compact was actually proposed by Draghi.
Yep, absolutely.
Yeah? So what
December 2011.
December 2011. So the thing basically, I think the fiscal compact was seen as in let's say reform of the institutions, in let's say anchoring fiscal discipline on a more permanent basis, because it had to be inserted in national constitutions in the euro area countries. And as a counterpart of that, there were actually two things which were on the, let's say, more risk sharing side. So you can look at the risk reduction, risk sharing, on a parallel way throughout the crisis. So the fiscal compact was on the discipline side. What was on the other side of the balance sheet? It was on the one hand the agreement of Germany and the others to establish the ESM, EFSF first, ESM later, which has been heavily contested also before the Karlsruhe Constitutional Court
so
in Germany.
The crucial thing about the ESM is it's a big pot for buying sovereign debt of states which are at risk of losing market access. And the big argument was about whether or not it would only jump in to buy in cases of emergency where a state was losing access and needed to issue new debt, or whether it could be used to actually manage the bond market on a running basis, the way that, say, the Fed would do, and the ECB was doing and then not doing, and going back and forth. And the Germans agreed to bring the formation of the ESM as a permanent institution forward in exchange for collective discipline in December 2011.
That's right. So you reconstructed well the events. So this, on the one hand, there was this, let's say, the liquidity backstop. And the other thing is the, let's say, in a sense, the ECB feeling more comfortable in actually stepping in and doing what it eventually did in terms of very strongly accommodative monetary policy, both the unconventional and the conventional side. I think this is a reasonable reading of where you see how you place the various elements. What I would not agree is the deliberate squeezing of individual countries in order to, let's say, with the austerity, in order to push them to the limits. I think this is. I would not subscribe to that more Machiavellic reading of the thing. In terms of the risk sharing, risk reduction overall, I think this is yes, and I think that's. What I indicated at the beginning, namely that these underlying divergences during the pre-crisis periods, which led to divergent social and political preferences. You have seen some of you the Brunemeyer et al. Book on the origin of the Franco-German divide being rooted into the history of.
Moreno discussed it with us here.
Precisely.
When it came out.
Exactly. So when which is I think it's a good book in tracing back where where the blue and the red little squares that I showed.
Put that slide up.
Comes from.
So it's a book which argues that historically the EU and also its current options are, as it were, defined by the contrast between the German and the French approach, with the French favouring the red options here: activism, discretion, solidarity as a kind of principle, and then the Germans insisting on this
Yeah.
rather different vision.
I think basically here, in the, what is behind, I think this divide here, and this has been in the common market before and the EU later, and we have always progressed by bridging the two sensitivities. It's not something new, and actually, provided that the compromise is a genuine and forthcoming one, is the way we have pushed the frontier of integration. I mean, the historical roots of this actually they're based. You can trace them back in the 1920s and the 1930s, with the countries having been stung by the hyperinflation, and which led to the debasing of money during the Weimar Republic. So this is on the German side. So the hyperinflation being in the collective angst, and the French instead having much more the fear of the massive unemployment during the 1930s following the Great Depression. So this is and what is important actually for Germany in particular, I think is nicely reconstructed in the book by Brunemeyer and co-authors, is that the formation of the Federal Republic of Germany after the Second World War was very much, the Allied did not want to have a strong center. So what they did, they had the lenders, and you have a relatively weak federal center in Germany, very much organized through rules. So the rules-based system, which is so dear to Germany, actually you can trace it back, to that period when the Federal Republic of Germany was actually. So there was in order to have a discretionary policy, you actually need discretion and a strong center to decide. And in Germany, that is less strong. That's why you had this all these rules-based element you see on the blue side thing. So we have to, I think, bridge the two. And the key issue now is that are there the political conditions in order to make the decisive, I'm not say leap forward because that's a bit too big, but say decisive progress now after especially in the present juncture where you have the economy expanding. So in a sense, it should be easier to make, at least from an economic viewpoint, to make difficult choices. We know that when economy expands, you can actually compensate the losers more easily. Though this applies at the national level, it applies also at the European level. But, and the big but is that in the past we have made progress actually when we were shoulder against the wall. So we had to defy and defeat what I called before the ultima ratio mode. Yes. So can we just sit down and wait for the next crisis to make another leap forward? The proposal of President Juncker in the State of the Union about 3 weeks ago was no, let's push now because we have this window of opportunity. Let me make a comment maybe on the German side because in most of the media, the German electoral results have been seen as a break on European integration. Now, Germany, IFD, say 12 to 13%. So for the first time in parliament in the Bundestag, extreme right nationalist, in part revisionist party. So revolt against immigrants, etc. So which would this new configuration with the end of the Grand Coalition to lead to stop in the integration process? Now, I think this reading is a bit superficial, and probably the people jump a bit too easily to a negative perspective. it would, I mean, with Germany becoming more inward-looking, it would imply that the problems that have been highlighted by essentially by Alternative for Deutschland could actually be solved by Germany alone. But is this the case? I mean, if you have an issue with immigration,
Yeah.
I mean, you can certainly try to better protect national borders, but you know, I mean, realistically, it's only a proper response at the European level that can tackle the problem in earnest. So, on that front, I don't think that Germany would become more inward-looking. In terms of the imbalances and lack of domestic demand, I think what one can certainly expect if the three-party coalition goes forward with the Green, the Liberals, and the Christian Democrats, for sure there will be, I think, higher investment. This is, I think, the Green also will insist for that, and I think there will be a reduction in taxes. This is likely to boost demand and help to reabsorb imbalances. So I do not think that the simplified reading that now the door is immediately closed after the German elections to further progress in integration is I think it's probably too early to tell them and a bit too simplistic.